This is the chart of the week, and today we are looking at producer prices and consumer inflation CPI, and we also have the Fed fund rate here, and down here we have the non-farm payrolls. Everybody looks to what the Fed will do next week when we have the Fed Open Market Committee, or the FOMC. They will come out on Wednesday, and we're going to see a cut in the Fed fund rate. And most likely, at least that's what the market expects now, we're going to see a 25 basis point cut, so down to around 4%. It's a level. It's not a specific point, but it's a level where they try to keep the Fed fund rate at. And we also now see that the PPI yesterday actually were very weak, below the expectation of the market. And that's not so surprising when we know that the economy seems to be deteriorating, rolling over, as we've seen into the recession here in 2001. We've seen it into the 2007 to 2009. We saw the deterioration, and that's where also prices come down. Only they do that lagging. They lag somewhat. And back here in inflation was actually moving higher, even though the Fed was cutting Fed fund rate. And actually in September of 2007, which is here, we could see how the PPI numbers and the CPI numbers, the CPI were around the same level, which was here. The PPI numbers actually did spike somewhat into the final part, or into the early part of the recession in 2007 into 2008. And that's quite normal. You can see that into a recession. We also kind of saw it into the 2001, but still the Fed was aggressively cutting at these times here because the deterioration in the stock market, in the labor market. And I think we've gotten to that point now where the case for a 25 basis point is 100%. That should be coming at least, because we can actually see that this time around it seems like the CPI and the PPI numbers are at least at level or at pair with what we had here in September of 2007, where we had a 50 basis point cut. So and also if we look at the levels we now have on the non-farm payroll, which is down at 22,000, which was the latest number, and we have some serious downward revisions on for until March of this year. So, and we'll have to see what the later months will bring when we have the revisions for that at a later stage. Well, it looks like things are rolling over and not accelerating at this point, and that's why the Fed needs to step in and become more accommodative. Will it be 25 or will it be 50 basis point? I don't know. I think it'll be one of those. And the CPI number today is probably going to give us a very clear heads up on this. If we're going to see the CPI coming out weaker than the market expects, well, then I think you could see a potential 50 basis point. It's not unrealistic, but it could also turn out that this can actually be the straw that will break the camel's back. Not in terms of inflation moving up, but actually in terms of the market starting to understand that there will be an end to the bull market, and that the economy is now deteriorating quite fast, and that the Fed is behind the curve. Let's see what the CPI number brings today. I think that it may be weaker, but we have to see. It's been surprising somewhat before because the consumer inflation numbers are somewhat lagging, and that's why it's sometimes a little difficult to see that the connection to the real economy, but doesn't mean that the direction will not be to the downside, which I think is quite clear at this point. But that's all for today for the chart of the week, and I'll be back next time.